The economic picture is changing so quickly that it is very hard to see risk being on in any kind of sustained fashion in the equity markets. Because you've got two rocks essentially, and we're squeezed in the middle. Either rates stay higher for longer, in which case you have persistently high inflation that's not coming down. It's hard to see an equity market floor and sustained rally on that. Or you see rates being cut, in which case you've got other issues, i.e. you've got much lower growth and you've got much weaker economy and a recession, in which case it's also hard to see sustained equity market upside. So I think for equities, it remains very volatile, some pockets of opportunity, of course, but a sustained risk-on rally is going to be hard to find. So I think investors have to beware there. In the bond market, definitely more opportunity there to be idiosyncratic. Certainly, if anyone is not managing cash properly, that's on them at this point, because there's some good rates available to avail of cash usage.
Taking your comment, isn't it clear from what Powell said this week that he doesn't care about the economic consequences or the consequences for markets at this stage? His primary goal is to tackle inflation. And it seemed that the messaging was very clear. Don't anticipate a pivot anytime soon.
That's right. And I think without a pivot, it's hard to see risk-on mentality come back. There will be on and off based on news flow dragging the markets one way or the other. Now, Powell is saying, listen, we're going to be gradual to a higher peak rate. And you see the Bank of England's gone the other way, saying, listen, we're going to go faster, but the peak rate's going to be lower, and we will be looking at a pivot sooner. But also the UK economy is in a very different place. The US market, we'll see from the labour market numbers today, is in a very different dynamic overall, still very hot on the consumer side, which is trying to cool down. I think the Michigan survey said it all last month, right, where despite everything the Fed has done and said, inflation expectations are still higher than they would like it to be.
Can we talk about the split then that we're seeing between some of the central banks? The language is quite different now. If we take a look at the Bank of England, Bank of Canada, even the Reserve Bank of Australia, all this versus what we've seen out of the United States. How do you play that as an investor?
As an investor, you've got to be very cautious as to what you do on a basket basis now. This is a time for traders, right? Idiosyncratic moments will always present themselves. So for retail investors, it's find your best managers in an environment like this and give them the money to do it, because the chances of being burnt are quite high. But as an institutional investor, you're doing one of three things. Number one, you're dialing up cash, right? Cash is being very productive for you. Number two, you're thinking about what to do in fixed income now, given where rates have headed in the short end. It's not a bad place to go long bond markets at this point, and holding some baskets, certainly in the short end of the US curve, will behoove you. Number three, you're paying differentials. You're paying sector differentials. You're looking at sectors that do well when inflation comes down, but aren't really that persistently needing the growth elements. So you're looking at insurance, business services, cybersecurity, data centers. Those types of sectors will outperform in environments where growth is slower, but inflation's coming down too.